going on, everybody? Good morning and welcome back to Beat the Bell. Hope you guys have all had an awesome week. Final episode of the week. Let's get started with Money Mander. Money Mander, good morning.
Good morning. Happy Friday. Great segment coming up for you.
All right, Diamond Trades, good morning to you.
Morning, team. Happy Friday. Let's get after it.
And Stock Snipa.
Good morning. Happy Friday.
That's the spirit. Fed forecasts and economic calendar. What do we got?
Unmuted. Let's start with the economic calendar for next week, since there is nothing really high impact this week. Next week definitely gets interesting towards the end of the week. Consumer inflation expectations early, nothing on Tuesday. And that big old CPI print on Wednesday. That's the last one before the Fed meeting. PPI on Thursday, retail sales as well. And then we'll have the Michigan consumer sentiment before the close. So things begin to heat up towards the end of next week. And then the week after that, you've got FOMC. So the middle of September, definitely packed with some high impact news that I'm sure will provide some volatility for the market. Let's go ahead and dive into this week's trading. So the market is playing a bit of a Groundhog's Day trick to start the month here of September, performing similarly to the sluggish start that characterized August. Since Tuesday's open, the Dow shed 0.9% with the NASDAQ and S&P having lost 1.4% and 2% respectively, led largely by the 3% plus drop in Apple following news out of China, which we'll get to in just a bit. Weekly jobs data Thursday morning came in lower than consensus with 216,000 jobless claims versus the 239,000 expected. Yet another sign that the labor market is continuing to run hot, even with next week's CPI print, which is the last data that we'll get with direct implications on the Fed, on the Fed's decision on their meeting on the 20th. Traders aren't worried about the potential of a hotter than expected inflation print, coupled with a stubbornly tight labor market that will cause the Fed to raise hikes. In fact, the probability of rate hikes based on federal funds futures is actually down this week to 5% from 12% just a week ago. So we'll have to keep an eye on that as the news rolls in next week. Back to Apple. So China ordered officials at central government agencies not to use Apple's iPhones and other foreign branded devices for work or bring them into the office in an effort to shore up cybersecurity amid escalating tensions with the West. Apple, who nearly 20% of their revenues actually come from China, 19%. I believe in the last quarter, saw shares fall more than 3.5% Tuesday following the announcement on fears that A, similar restrictions may spread even beyond just government employees, and B, their share of the smartphone market in China, which is currently a dominant share, may be challenged by domestic producers, namely Highway. China is taking action against the largest American company, likely to draw some retaliation, right? I mean, you have to think Apple is really the flagship company of obviously the United States and kind of the whole world. To see China take a relatively restrictive action against Apple, it makes me feel like some sort of retaliation is coming down the pike. Not that we haven't been levying subpoenas and not subpoenas, but restrictions on some of their companies as well this entire time. But I think, this action is definitely going to want to warrant some sort of retaliation from the United States government. So that's definitely something that we'll have to watch going forward. Mander, what do you think?
Yeah, I agree 100%. I think it's interesting to see Apple, the largest company by market cap. I believe it was down like 7% on the news over the last 2 days. The markets really haven't felt all that much in comparison to what you would expect with a 7% down move in Apple. And I think some of that is based on relative strength elsewhere, some of that being in Meta. So that's kind of one I'm watching. Obviously, you're saying with retaliation of US versus China, the big speculative play would be they go ahead and then ban TikTok, which obviously would lead for a massive move to the upside in Meta. So that's one I've kind of kept on my radar. As we saw a lot of the outflow of Apple this week, a lot of that was uptick volume in Meta. So I think that's kind of where investors are looking to get positioned for that retaliation move moving forward, should we get one. But I'm back for my segment with debt market analysis yet again. And since the 10-year began its recent run, I'm going to talk yields here again and what this could mean outside of everything else we've covered. Since the 10-year began its run up through 4% and back to 15-year highs at the start of August, the S&P and NASDAQ are both down roughly like 2.5% from the start of August. But kind of similar to what we saw at the start of the year, the lead in the sell here has been banks amid duration risk fears yet again, and those unrealized losses. So as we can see right here, The FDIC just stated that combined unrealized losses for available for sale and held to maturity securities across banks totaled $558 billion in quarter two, which was up 8.3% from the first quarter. And that was back when the 10-year was trading at like 3.85% back in quarter two in the end of July. So that's likely far greater right now, as we see the long end of the yield curve has moved up substantially since then, just about a half percentage point to the upside on the 10-year. So really where the worst of this has been felt is obviously the regional banks outside of XLF. So we have the S&P and NASDAQ both down roughly 2.5%. XLF is down about 3.5%. KRE, the regional bank ETF, is down 11.5% from the start of August. And so as we start to see that landslide move over, IWM and the Russell 2000 has probably felt the worst of that hit. This kind of could stem to the rest of the markets. If we look really to the correlation here between the 10-year real yield, which we've spoke on, and then the S&P 12-month forward PE, we're seeing a divergence here really from the start of the end of last year, but up until now has continued to diverge that we haven't seen in nearly a decade, Ryan. If we can get the second chart, we have inflation and cost of capital, which were both at historic lows over the past 10 years, kind of putting real yields negative there for a 2-year span, which obviously leads to economic growth. And investors are incentivized to invest with no opportunity costs elsewhere. No one is going to lock in a -1%, -2% yield instead of getting in a growing economy in the stock market. And so you can see that's why we got that sharp bounce back at COVID when they sent rates back to at or near zero. But off of last year's lows, markets have rallied substantially and kind of squeezed these forward PEs with projected revenues moving forward and projected profitability over the next year not at all keeping up with the rise we've seen in stock price. And so kind of as we're getting this divergence here, you now have the 10-year real yield almost at 2% with the S&P 12-month forward PE up about 25% off of last year's low. So what I'm kind of curious about, and I want to throw this back to you, Diamond, is do we think the markets can remain resilient until rates are cut? And we would see the bottom of that jaw that's opening here move up as rates get put back to at or near zero, lowering that real yield? Or do you think we kind of meet in the middle and get a substantial pullback beyond seasonality moving forward?
I almost feel like a best case scenario for, I would say the best case scenario for people who are looking to not necessarily aren't fully invested right now, but would look to buy dips in X, Y, and Z would be for the Fed, would be for the market to sort of, because you have to think about it from the standpoint, right? If the Fed is going to cut rates eventually, right? So let's say that they cut rates like this time next year, like what does the landscape look like where they feel comfortable cutting rates, right? Because right now you look at unemployment extremely low, you look at inflation, which is on its way down, and the economy is, like you said, guidance isn't necessarily great, but earnings aren't coming in, horrible. Earnings are coming in pretty solid. Like what has to deteriorate for the Fed to want to say, okay, you know what, things are getting a little bit ugly over here. Let's cut rates. Because if we go to next year this time and inflation is still trickling down towards our target, you still have employment running pretty hot. Like what's their incentive to want to cut rates? Like that's what I don't understand. So for me, like the whole like let's cut rates, I feel like yes, while that is ideally what like investors want to look forward to because it's just associated with things being bad, and that's a great time for us to buy, right? When things are bad, the Fed is cutting rates, the world is sort of on fire. That's a great time to buy stocks, and that's why everybody wants to buy stocks that's why everybody wants the Fed to cut rates, right? Cut rates that the market can rally, market can rip, but you have to understand like what has to happen for them to want to do that, right? And so I mean, I don't necessarily think that especially if no sort of like outside sort of catalyst happens, I just really can't see us necessarily cutting rates even back down to like 0%. Like we're pretty elevated right now. We're higher than we've ever been in terms of where the 10-year yield is, where the federal funds rate is. What if they cut rates slightly and just left them elevated up here at like 3%, right? And then you still have like a positive real yield, right? And I think that still is going to put some sort of pressure on the equity markets relative to that 10-12-year period where we just had 0% federal funds rate, right? And so I think that even if there isn't that necessarily like black swan event that something really, really bad happens and the Fed has to go all the way to zero in terms of rates, and things sort of just remain sort of calm. I'm literally describing a soft landing at this point. Things just sort of ease their way into normalcy. You could see a situation where rates do come down, but don't necessarily go back to zero. That whole ZERP, era of, things ripping 100% in 6 months type of market. I feel like that's what people really want when they say, we're waiting for the Fed to cut rates. I hope that they cut rates. They want like a 2021. That's what they're looking for. And I don't think they're going to get that.
I think that's the paradigm we're kind of seeing, especially when you see economic data releases. First, last year, good news was bad news because then it meant the Fed had to continue hiking rates. Then good news was good news because it meant we were avoiding recession and the Fed was doing their job. And now good news is almost bad news again because it's showing that the economy is resilient and the Fed really can hold these rates higher for an extended period of time without inducing a black swan event. And we're kind of starting to see that repricing almost every other month. We're seeing something go back and forth with how Wall Street's reacting to this data. And I think to your point, the soft landing is probably the largest probability right now. But then even that moving forward, that would just be slow economic growth and really a slow trickle higher versus, getting back to a ZERP where we would see markets explode. But at that point, what's the Fed accomplished by doing that?
Right. Well, look, things could stay like relatively normal for like a lot longer than people expect, and we could just have like a range bound market. I mean, go back and look at like really 2001 to like 2008, we really didn't go anywhere, and the markets go back to like just before the run in the 90s, we really didn't go anywhere on the market for like 12 years. Like this could very well be one of those sort of situations where nothing bad enough happens to send the market to fresh lows, but like you said, that growth is challenged just by the fact that rates are so high, not necessarily so high, but not at zero, right? We're so used to having them at zero that I think that anything above that is going to cause some sort of, uncomfortability from an investor standpoint, particularly in stocks. That'll wrap it up for us here at Fed Forecast. Pass it back to Alejandro.
All right, thank you, gentlemen. Let's take a quick look at the system. So we, of course, got the sell signal on the 30-minute chart back on the 1st of September. So pretty timely there. So we also got the break below the 1 hour 50 SMA. And as you guys likely have noticed, if you did some trading this week, there was definitely a bit of a shift in the market in the sense that not only did we sell off, but longs in general were getting very little continuation. And between, sandwiched between, we had some chop in between. That was a nice trend leg that was sandwiched in between. But these conditions up here and what we got yesterday, really choppy. And yesterday was also the rollover for the S&P futures contracts, the E-minis. I think that did have something to do with it. But seasonally, this is the type of stuff that we're going to see in September. September is a difficult trading month historically. And so we just have to be ready to adapt. And, obviously, as always, first things first is recognizing that risk management is number one. Okay. And the reason I say that and why it's so important is because we have gotten some really high quality trading conditions as of late. Whether or not you've been able to recognize that, that's really what we got. The summer rally was beautiful. That was the time to kind of pad the accounts as we move into some more difficult trading conditions. But as far as the technicals go, what we're looking at currently, we're trading below the 50 SMA on both the 1 hour and 30-minute charts. So you guys know what that means. Bears are in control until they can reclaim. And that's how we should be moving forward. So if taking any longs, you're going to want to size small. That's number one. Number two, you're going to want to expect little follow through. And the reason I even bring up taking longs is because just because we're trading below the 50 doesn't mean that there aren't going to be opportunities to get long. You just have to understand the risk, okay? Because in the past, I've made the mistake of blinding myself to only looking for shorts, right? But there are some really nice longs that'll pop up. So just keep an eye on that. That's going to do it for the system. I'm going to move over to Stock Snipa now for Bet the Bell.
Oh, wow, it's muted for a while. We're going to start it off with our typical way. We're going to look at the statistics. We're going to see Alejandro and Diamond have been going neck and neck. And we can see right now that Diamond is 1 win ahead, 67% versus 65%. Could be the day, any day now, but we're going to see how it goes. But I'm going to start this off with our typical question, green or red? I'm going to start this one off with Money Mander.
I got to say, Noah, good numbers there. Hitting over 2/3, over 66.6%. Good stuff. I'm going to take green today. I think VIX Crush Friday has been hitting at like an 80% interval. So I think we see a down day in the VIX, green day in the indices.
I like it. Honda, what you got?
Green.
Green. That didn't seem the most confident.
It wasn't.
Diamond Trades, what you got?
I'm going to go green as well. I'm going to go green as well. Hopefully retrace back into the weekly range.
So the key for doing what I do is once Alejandro makes a face, I jump over to Diamond right away so he has no defense when I tell him he looked a little inconfident in his answer. Now, it's time for the fun stuff. I'm going to go ahead and ask you guys, right? Is AI dying or is it just getting started? Now, the question and the detail behind this is we can see now ChatGPT is having 3 months in a row with lower users. That is a steady downtrend right there. What do you guys think? I'm going to start this one off with Alejandro.
It's definitely not dying. It's just getting started. I mean, using ChatGPT as, a metric for all of AI, first, you can't do that. But that's kind of how things work. It's just a hype cycle, right? And so as people get excited about it, they check out the platform. That to me has, very little to do with the actual impacts that AI is going to be able to make in the future. And so while there's going to be those periods, ebbs and flows where people get really excited about AI or there's new technology, it's like the market, right? I mean, people get excited, they buy stocks come down, and at the end of the day, stocks go higher. So that's what I think we're seeing here.
I like that answer. I'm going to go ahead and jump over to Money Mander.
I'm going to say the exact same thing. I think ChatGPT is basically like a needle in the haystack of what AI really is. It's like the tip of the iceberg kind of thing. And so seeing metrics go down on a generative AI tool online that writes essays and scripts code and stuff like that, I don't think that fully represents what the capabilities of AI really is. And so I would say as a whole, AI is 100% just getting started. And maybe the hype was a little overbought here as people kind of stamp ChatGPT with AI, because that's really the only, as a consumers, that's so far the only thing we've really gotten to experience was that in terms of generative AI. But I think if you kind of look at the whole bubble, it's definitely only getting started here. I would say the biggest parts of AI haven't even been released or unveiled yet. Like people haven't even been able to capture the mass of what AI really can do yet.
I agree with that. Diamond Trades, what you got for me?
Yeah, I'm going to go in a similar direction. I think that like when you look at the early adoption of the internet, it's like, oh, the internet, and everybody gets all excited. And then I think people run and try it out and realize that it's not necessarily as applicable to their everyday lives as they thought it might be. And so they, put it on the shelf like a toddler does with a new toy. And then down the line, like Alejandro said, as sort of AI is able to develop and become, more seamless, in our everyday lives, and people realize the actual benefits that it has, I think that, inevitably people work their way back to it, whether that's in ChatGPT or whether that's in some other form. So yeah, I don't necessarily think that this is a kiss of death for AI at all.
I like that. I agree. There's lots of different forms of AI. I mean, we're seeing anywhere from picture generation, tattoos. We're seeing all different kinds of AI generating generative things. We're also seeing AI inside of technology. I saw like shoes that actually adapt the way that you walk, and it apparently like it makes you walk at like the speed of 12 miles an hour or something, which is kind of ridiculous.
Yeah, I think a cool thing too, right, is like you think about what it's not even just like what AI is, it's what AI enables, right? It's like the internet itself is sick, obviously, but like the internet enabled mobile phones, right? The internet enabled you to be able to have something in your pocket that you can use to connect to the internet with. That idea wasn't even a thing when the internet was created, right? So it's like AI is going to enable the next thing, right? And so, whatever that is, it probably isn't even invented right now, right? So it's like, you got to give it time, and innovation will always prevail.
I like it. So I'm going to go ahead and ask you guys the next question. So I'm not sure how well you guys have been keeping up with Disney and with Apple. We can see that both of them haven't been performing that well this week. We can see that Apple, I believe, had $180 billion wiped off of its market cap in the last 2 days. But my question for you guys is, would you rather own $500,000 worth of Disney or $300,000 worth of Apple? You must hold it for at least 1 year. I'm going to go ahead and start this one off with Diamond Trades.
Ryan, I don't know where you get those graphics on the bottom from, but that's pretty cool. I like that. Well, I'm going to go with Apple. Obviously, I own both. Wish I only owned one of them. So,
So you're taking the $200,000 hit?
Yeah, sure. I actually do think that I would do that. I mean, Disney is weird because it's one of those it's one of those names that I feel comfortable buying even when it's down, just because of the brand itself. But like from a business standpoint, they're just like mis-executing aggressively at the moment. And so I'd be making a bet on like management, really, that they're gonna, out execute, somehow change things in the next year, which they very well may. It's not impossible, but I really don't know enough about Disney to know the inner workings of what exactly needs to be done over there and how much work it's going to take to get them out of this funk that they're in. And so for that reason, I'm going to say Apple.
Okay. Alejandro, what you got for me?
Definitely Apple, dude. Apple's fucking free money. I mean, it's the sickest stock of all time. It's the greatest stock ever. Literally ever. It doesn't go down. Buy Apple, it's gonna go
7% this week.
Buy Apple, it's gonna go up. If it goes down, buy some more because it's gonna go up eventually. Okay. I mean, it's Apple. I mean, I don't even think there's a real debate here, if I'm being honest.
Let's see what Mander's got to say. You taking the Disney?
I'm gonna take a gamble here because I've heard a lot of talk through the grapevine that Apple may be in talks of acquiring Disney. So I'm going to take my $500,000 of Disney, hope that it physically can't go any lower because this thing sucks at $80 right now, and then hope that Apple buys it out, and then I get $500,000 in Apple.
Jesus Christ.
That is a 200 IQ answer right there. Mander just cheated the system. Mander just figured out how to get.
Who's the guy from Reminiscence of a Stock Operator, Jesse Livermore or whatever? That you're a speculator now, Mander. You're just taking massive bets. And
$500,000 speculation bet here. And look, even if Apple doesn't buy Disney, how much lower can this thing go? It's unbelievable. I don't know how much
famous last words. Don't ever say that.
That's the scary part about it. It's like, why is it in a good market? Like, why is it going?
Because it has nothing to do. It's them. It's literally them. It's management's mis-execution on literally every single aspect of their business. Like, that's why their stock is down.
Igor back, or however you say his name. But
Igor, yeah. Didn't he come back? I thought they had Shapek in there for a little bit, and then Igor was like, step aside. I thought that's what happened.
I'm sure he
came back.
All right, guys. So I'm going to jump over to my next and my final question of the day. This question has been asked about a year ago, and I'm pretty excited to ask this question. Always get some really interesting answers here. But if you could own one private company, what company would this be? I'm going to start this one off with Diamond Trades.
One more time. I'm sorry.
If you could own one private company, what company would it be?
OnlyFans. That's a lot. What did the owner bring in last year? Didn't he pay himself like Something
500 million.
absurd. Was it only 500 million?
I think it was 560 million.
Okay, yeah.
I think
What
he
is
would have
that?
been the highest paid CEO though if it was a public company.
Yeah, I didn't mean only like that, but like, 500 million is 500 million. But yeah, OnlyFans.
522 million.
Yeah, without a doubt.
Mander, what do you got?
That's crazy. He actually 10x Tim Cook. I'm gonna take one, not really on the potential profitability, but just for my personal kind of intrigue. I would love to own a chunk of SpaceX just because I'm super intrigued by what they're doing. I find it extremely impressive. I watch the live rocket launches, like the self-landing propellers. I just find the thing unbelievable. So I would love to own some SpaceX.
I like
What
it.
a nerd.
Alejandro, what you got?
Can I own Chick-fil-A?
I knew you were going to say that. I swear to God, I don't know how, but I just knew you were going to say that.
Because we're boys.
Get franchise one.
Yeah, but
think
that's,
so, too.
I don't want a franchise. I want
you're saying if you could
I
buy
want to be the big dog. Is there a guy out there who's like, I'm the big dog who owns like fucking 50 of these things? I don't know how it works. Anyways.
Yeah, so
if Chick-fil-A ever went public, I would invest. I guess maybe that's a better way to answer. But yeah.
now I'm kind of stuck. I'm left with all the garbage companies. Shit.
We named 3 companies, bro.
I know, man. I would say
family
OnlyFans
business
and
owned by
Chick-fil-A.
2 Hondo. It's a family
What'd you
business.
say?
It's a family business owned by 2 brothers, the Cathy family. Yeah, so you could definitely
That's what I'm talking about.
Be one of them.
Oh my God, Dan Cathy, $10.7 billion real-time net worth. That's what I'm talking about right there.
Wow.
Dan Cathy, fried chicken billionaire. That's great.
It's a sick title to have.
Don't get Snipes out of giving his answer here.
Yeah, what do you want, Snipes?
Thinking about it.
Come on, bro. It was your question. You have like one.
You only knew one private company.
I knew 2, and they were both taken.
You're nuts.
I don't want to name a company and find out that it's public, and I'm just unaware of the stock.
No, you should do that. That would be funny. Do it. Just pick your favorite.
Chicken Kitchen here.
What is that?
Chicken Kitchen?
Yeah. I'm thinking Chicken Kitchen.
Publix?
Oh, that's like only in Miami.
That's only in Miami?
I've never seen a Chicken Kitchen anywhere.
Never heard of it.
Wow.
That's hilarious.
Oh, man.
All right, you'd be the king of Broward County.
I already am.
Oh, my gosh.
But yeah, that'll wrap it up for Bet the Bell today. I'm going to pass it back to Hondo here.
All right, guys. Thanks for joining us. We'll see you back here on Monday. Hopefully, you guys have all had an awesome trading week. We'll be trading live all day in the King Capital Discord. Go to king-capital.com. Other than that, knock it out of the park this weekend, and we'll see you guys on Monday morning. Take care, everybody.